Hey Angelina, this is Ms. Morgan, and I just got your message. I decided to try out my new pen. I just got an Equil pen, and I'm trying to do a recording here. And if it works, I'll go ahead and post this in the discussion board for all the students to see, because you will have some Chapter 12 questions on the midterm, so you will need to review some of these concepts. It's exercise 1216, and first of all, it says that Overton and Testerman have capital balances of $180,000 and $120,000. And then in early January, Randy Campbell is admitted to the partnership by contributing $75,000 for a 20% interest. The first thing you have to figure out is, what is that 20% interest worth? So the way you figure that out is you take the total equity in the business, the total net worth of the business before he brings in the cash. So $180,000 plus $120,000 is $300,000. That's the net worth before he brings in the cash. Plus the cash will be plus $75,000. So the new equity of the business is $375,000. So $375,000 is a new net worth. We're going to give him 20% of that. And when you do the math, you see that 20% of $375,000 is exactly $75,000, which is what he put in. So since what he paid is equal to what he got, then he did not receive a bonus and he didn't pay extra. So the other partners didn't receive a bonus. It's just he paid $75,000 and got a $75,000 capital account. Let me write this so you can see it a little bit better. That's a 75,000. I'll just write over that, sorry. And then later on, we're going to have to figure out their percentage of ownership. And so 20% is $75,000. We know that. To figure out their new percentage of ownership, you'll take $180,000 divided by $375,000 to see that O now owns 48% of the company. $120,000 right here divided by this $375,000 is 32% of the company. We'll use that in number 3. The part number 2, it says we're going to split net income, and we're going to offer salary to O for $40,000. So whenever you split net income, you need to create the chart like the one in the book, and I always add net income up here on the top right so I know what I'm splitting up. We promised a salary of $40,000, which means that we have a remainder of $110,000 that we need to distribute. And in the problem, it says that we're going to distribute the income sharing ratio equal to their capital balances after admitting the new partner. So that means that we're going to split this 3 ways: 48%, 32%, and 20%. So if you do the math, 48% of $110,000 is $52,800. 32% would be $35,200, and 20% is $22,000, which means that these partners will get this amount added to their capital accounts. It's their portion of the net income. This is also the portion that they'll pay taxes on. So we're dividing up net income. Just to check your work, you're going to want to add these 3 numbers and make sure that they add up to equal net income, so you're not giving away more than what you earned. Okay? Then you're going to create the statement of owner's equity. The formula for the statement of owner's equity is beginning capital plus investments plus net income minus drawing. I have some Accounting 1 students that like to remember it this way. BIND is the formula. So the beginning capital for C is $75,000. It doesn't tell us that anybody made an additional investment. It actually says that early January, Randy added that money, so it could be in Cengage that this would be a 0 and the 75 would be here under additional investments. I'm not sure about that because I'm not looking at Cengage right now, but it goes in one of those 2 spaces. And then net income was divided up this way: 92.8, 35.2, and $22,000, and that is an increase to the capital account. And it says that drawing, we're going to assume that they took out half of what they got in this chart up here. So what you'll do is just take half of that, 92,800 divided by 2 would be 46,400. Half of 35,200 is 17,600, and half of 22,000 would be 11,000. And the way to figure out their ending capital balances, and that's what's going to go on the balance sheet, remember, their ending capital balance is you'll say 180,000 plus 92,800 minus 46,400 equals 226,400. Remember to subtract out drawing. The next partner, T, gets 120,000 plus 35,200 minus 17,600. 137,600. And the last partner, 75,000 plus 22,000, which is his share of net income, minus 11,000. Oops, typed that in wrong. Would give him 86,000, and that would be their ending capital balances. If you had to find the total owner's equity, you would just add all three of these together to get total owner's equity.